In this presentation, we will discuss capital assets for governmental accounting. As we go through the capital assets, we want to compare and contrast it to a for-profit type of organization. We're more familiar with the for-profit organization. When we go to the governmental accounting, the capital assets, many of them will look much the same. Those assets that are typically depreciable assets, those long-lived assets, property, plant, and equipment type assets, although some of them may differ for a governmental entity, and the way that we acquire those types of assets may differ than the common or the norm way we would acquire them in a for-profit type of organization. First, we have land. Note that land is not depreciated as it is for a for-profit type of organization. In other words, if we're talking about actually the dirt, we think in the dirt doesn't go down in value over time as does the things on it, such as a building. Therefore, although land grouped in capital assets type of a depreciable asset kind of category, it's one that won't be depreciated because of the nature of land. How are we going to value the land? In other words, what are we going to put it on the books for? In a for-profit type of organization, typically we would get the land through purchase, some type of business transaction, and therefore have the market to help us out to know what the value of the land will be. When we think about a governmental type of entity, then we might acquire the land in different types of way and therefore not have the market to help us with the valuation all the time. So the valuation will depend on how it was acquired. If it was purchased, we're going to take the contract price plus any related costs. That would be similar to a for-profit type of organization. We can use the market then because the assumption is that we purchased it at the market price. Well, what about the case of a forfeiture? For example, what if someone doesn't pay their taxes and the land is acquired through a forfeiture? Then we're going to put the land on the books. We're going to value the land at the total of the taxes, liens, and other claims surrendered and other costs incidental to acquiring the ownership and title of the land. And then we could have a situation of a donation. What if there's a donation of land to the government? In that case, we'll put it on the books at the appraised value at the date of acquisition. And this is going to be a common type of test question. If there's going to be a donation common question, do we put it on the books at the donor's costs minus the accumulated depreciation, or on the books at the appraised value? And of course, we're going to take the appraised value because we're going to think that that's going to be closer to the fair market value. Note what we have here is land. We don't really know what the fair market value is until we sell it because land is unique in nature. And therefore, we need the market really to tell us what it costs. The best thing we can do to get the fair market value at that point in time is to have an appraisal of it at that point in time. That's what we'll do. We'll put it on the books at the appraised value with the donation. Then, of course, we have buildings and improvements. So we think about the land. That's going to be the items that's not going to be depreciated. We have the same kind of problems or issues in that we have land and building. We often have to break out the costs between the land and the building because the building and improvements are typically going to be depreciable, whereas the land is not. This category includes the buildings themselves. It includes the building improvements, so improvements on the building. And these are things that are typically going to extend the life of the building. And then we have the land improvements as well. Then we have the same issue with regards to the building and improvements. What cost or what amount are we going to put these on the books for? And again, it's going to depend on how we acquired the building and improvements. The most common way to acquire in a for-profit type of organization is to purchase the building and improvements. And then, of course, we have the market once again, and we put it on the books at the contract price plus any related costs. If we construct the building, then we have to determine whether or not we used an outside contractor to construct the building or if we constructed it ourselves. If we have an outside contractor, then the contract price and the costs of the construction of the building then would be included in the building. If we did it ourselves, if it was self-constructed, it would still be similar to a for-profit type of organization in that we would capitalize, in essence, the costs of construction. So the costs then could include cost of direct and indirect expenditures of the fund providing the construction and materials and services furnished provided by other funds. And then, of course, what about the case of a donation? Same kind of thing with a donation. We're going to take the appraised value on the date of acquisition. In other words, not going to put it on the books at the cost of the donor. We're going to look for the fair market value or get as close as we can to the fair market value at the current point in time because the building is unique. All buildings are unique. Therefore, we're going to have an appraisal. We'll put it on the books at the appraised value. Then we have the category of machinery and equipment, and we have the same issue. How are we going to put the machinery and equipment on the books? Same thing as for the building and improvements. If it's purchased, as it would be the case in a for-profit type of organization, we're going to put it on the books at the contract price plus any related costs. If we constructed it, if it was constructed by an outside contractor, then it's going to be the same thing as if we were a for-profit organization. We're going to put it on the books at the contract price and costs. And if we construct it, then we are in essence going to capitalize the costs of the construction as we did with the building and improvements. If there's a donation, then we're going to put it on the books at the appraised value of the property rather than the value of the cost at the donor's cost. We're going to put it on the current value as close to it as possible, taking the appraisal in order to get there. Then we have the infrastructure assets, and those are going to be things that are going to be a bit different than we're used to in for-profit type of organization, but we can still see that they're going to be long-term type of assets, things that may be depreciable, although they're going to be depreciated unless we have a modified approach. So we could depreciate them unless we've elected to have a modified approach. These are going to include things like the streets, storm drainage, sidewalks, and lighting. So we could think those are the infrastructure type of items, typically long-term items. Therefore, you would think that they would be depreciated. However, we could think of the situation where we would say, hey, we think we're going to maintenance the streets and the drainage and keep them up to a certain level to the point that they're not going to deteriorate in the same way as other types of fixed assets, and therefore there's a modified approach that could be used. If the modified approach is used, then we won't have the same type of depreciation that we would have in normal property, plant, and equipment type of items. So government may elect not to depreciate certain eligible infrastructure assets if two requirements are met. So here's going to be the two requirements if we use the modified approach. Modified approach means that we're not going to have the same type of depreciation on the infrastructure type of assets as we would with other types of capital assets. Number one, the government manages the eligible infrastructure assets using an asset management system that includes A, an up-to-date inventory of eligible assets, B, condition assessments of the assets and summary of results using a measurement scale, and C, estimates each year of the annual amount needed to maintain and preserve the eligible assets at the condition level established and disclosed by the government. Number two, second condition, the government documents that the eligible infrastructure assets are being preserved approximately at or above the condition level established and disclosed. Then we have intangible assets. And whenever you hear the term intangible assets, we have something of value. It's going to be an asset, but it's intangible. It doesn't have physical substance. So intangible asset, capital assets that do not have a physical substance, useful life of more than one reporting period. So it's going to have a useful life of more than one reporting period. Therefore, we're thinking about some item has value. It's going to be long-lived, has a useful life of more than one reporting period. However, it's not tangible. It doesn't have physical substance. And it also has to be non-financial in nature. So we're talking about a non-financial type of instrument or asset.